Okay, and hello and welcome to this lecture video. And so in this lecture video, I'm going to be talking about departmental income statements. I'm also going to be talking about return on investment, and I'll also talk about residual income. Okay, so when we talk about a departmental income statement, it's exactly what it sounds like. It's just an income statement that's made for one division or one department. So if we think about this in terms of the University of Mary Washington, we could have an income statement maybe for the College of Business, an income statement for the College of Education, an income statement for the Department of English and Communications. We can do that, and that's what we mean by a departmental income statement. When I used to work in industry, we would have income statements for the Military Systems Division, the Government Services Division, the State and Local Division. Okay, so those are some example departmental income statements. So when we say that will include our direct and indirect expenses, and so when we talked about direct in this case, we talked about direct expenses versus indirect costs or expenses in the past, and what we mean by direct versus indirect is that direct is it's easily traceable to the cost object. Indirect means it's not easily traceable to the cost object. The cost object, though, in this particular case, when we're talking about a departmental income statement, that's not the products that we make, but it's the department itself. So when we talk about direct, we mean, can it be easily traced to the department? Indirect, it can't be easily traced to the department. We talked about some steps in preparing a departmental income statement. We're going to track and accumulate all of our direct expenses, and then we'll allocate our indirect expenses across departments. So an example of an indirect expense across departments would be the janitorial department. Let's assume that the janitorial department, which is a shared department, goes to the assembly and finishing departments. So the janitorial department, they clean the assembly department, they clean the finishing departments. They would therefore allocate their costs to the assembly department and to the finishing department. And those expenses would show up in the departmental income statement for the assembly department and for the finishing department. Okay? Then finally, we would prepare departmental income statements. And so if we look over here, this is an example of a departmental income statement. So we have our sales for Department 1. We have our cost of goods sold for Department 1, same with Department 2. We have our salaries, and then we have our supplies expenses, and see how this says our direct expenses. That means that these salaries are for this department. These salaries are for this department. These supplies are directly traced to Department 1. These supplies are directly traced to Department 2. And then what we have is some indirect expenses. And so what we can assume right over here is that sales, Department 1 and Department 2, are probably in the same building. And so they have the same utilities, okay? And so you can see that we're combining them. And what we also might want to do later on, and we don't show this right over here because we're focusing on the departmental contribution to overhead, which is something I'll talk about in a second. But what we might want to do also is to allocate those costs out, as we've done in earlier lecture videos, between these two departments, okay? So let me return focus over here to our departmental contribution. So what we can see is the way we get this is we take our sales minus cost of goods sold gives us our gross profit. Then that less of our direct expenses, our other direct expenses. When I used to work, we used to call these ODCs, other direct costs. Okay? We have our total direct expenses, so we take our gross profit minus our total direct expenses, and this is our departmental contribution to overhead. So the way we calculate this number is we take our sales minus those expenses that are directly traced to that division, gives us our departmental contribution to overhead. And this is important, and let me come back over here and talk about that and hit some of these bullet points over here. Okay? This is really what I wanted to focus on, is that department could be a candidate for elimination if that departmental contribution is negative, okay? So we look over here, if this is negative, okay, that means that this department is not generating enough sales to cover its own costs. Okay? It's not generating enough sales to cover its own costs, and then that can be a problem. That doesn't mean that we should necessarily always get rid of it, because we might still need it for some other reasons or some other strategic reasons, but from a financial standpoint, that would be a problem. Okay? So let's go on and talk about return on investment. And this is the way that we would evaluate investment center performance. Okay? So return on investment is calculated by taking our investment center profit, our investment center income, divided by our invested capital. So if you look at this ratio, and this is expressed as a percentage, like 10%, 15%. If you look at how we calculate this, there's a couple different ways that we could increase our return on investment. If we increase sales, our income will go up. If we decrease operating expenses, our income will go up, because the way we calculate income is sales minus expenses. Okay? That would increase our income. Or we could reduce our operating assets, which is our denominator, our invested capital. If this number goes down, return on investment will go up. Okay? So those are some of those ways that we can do that. If we come over here, when we look at some example investment center problems, okay, you can look over here. We can say we have two different divisions, and we have LCD, and then we have the S phone. We have our net income, and then we have our average invested assets. So I take net income divided by my average invested assets, gives me my return on investment 21% versus 23% right over here. So then we have another example problem. We can just do this one together right over here. Our Davenport Mills is a division of Iowa Woolen Products. For the most recent year, Davenport had net income of $16 million. Average invested assets of $195 million. So when I want to calculate the ratio, and I'm just going to simplify things by writing 16 million, rather than writing out the whole number because I'm running out of space, 195M. When you do the math, 16 million divided by 195, that gives you 8.21%. Now, is this good? Is this bad? It's hard to tell because we don't have any benchmark to compare it against. So if we wanted to really see how well Davenport Mills is doing, which is a division, maybe what we could do is compare this return on investment number to last year's. We could compare it against a similar division. We could compare it against what maybe our budget was, maybe our target return on investment. And then we could say, this is actually what you did. You beat your target. That's a good thing. There are a few problems, though, with using return on investment for evaluating investment centers. And again, this is what we would use for evaluating investment centers, not profit centers or cost centers. And the reason that we wouldn't use return on investment to evaluate a cost center is because a cost center does not generate any revenue. So you can't hold them accountable for income because they don't have any revenue. The reason that you wouldn't use return on investment for a profit center is that a profit center does not have the leeway to invest in new assets. So if you don't have the leeway to invest in new assets, it doesn't seem to make sense to use a measure of how well you're using your assets to generate income, unless we give you that leeway. An investment center, as we talked about in an earlier lecture video, does have the leeway to invest in new assets. And so what we want to do is to evaluate that investment center using return on investment, which shows us how well are you using your assets to generate net income. Okay? Getting back to some of the problems with return on investment, when we look at the denominator, it's our invested assets. The problem is our invested capital or invested assets is based upon historical costs. So it's based upon the book value of our assets. And so if you remember book value, the way we calculate our book value is we take our asset cost, our original asset cost, minus our accumulated depreciation. And then that gives us our book value. And then what we know over time is that accumulated depreciation, this number goes up as we record depreciation every single accounting period. Accumulated depreciation goes up, which means the book value goes down because it's asset cost minus accumulated depreciation. Asset cost stays constant, that's the original asset cost, minus the accumulated depreciation, which keeps going up, means the book value number goes down. Okay? Now, this book value is the value of our invested assets. When we talk about the value of our invested assets, that's based upon historical costs, which means the book value. And that's what I'm saying right over here. We have some fully depreciated assets that could lead to a low book value and a low, therefore, invested capital number. If we think about how we calculated return on investment, income divided by invested capital, this number will go down over time, right? Because accumulated depreciation increases. And if this number stays the same, what happens to return on investment? You're dividing by a smaller number. The output, the return on investment number, therefore increases. Okay? And that can make comparison of investment centers using return on investment difficult because some assets may be fully depreciated in one investment center and not fully depreciated in another investment center. Also, continuing on this discussion of depreciation and book value and invested capital is that if you think about this, right, if I keep using my assets all the time, right, my existing assets, and I delay purchasing new assets, what happens to accumulated depreciation? It will go up, which means the book value goes down. And so maybe what I can do is use some depreciated assets to increase my return on investment. And what that does is for the manager, it disincentivizes them from purchasing new equipment. Because once they purchase new equipment, right, accumulated depreciation is very low, which means the book value is high, which means the denominator is high, which means the return on investment could drop. Okay, assuming that the profit is unchanged. Okay, so we look over here at residual income. What we talk about with residual income is the net income of an investment center that's in excess of its required profit. So what we have is we have some required profit number that we want to hit, okay? And then what we can say is how well did you actually do against how well should you have done, okay? So when we take our residual income, we take our investment center income, our NOPAT, net operating profit after taxes, and in additional accounting classes, you'll go through and talk about how to calculate that. So for now, I would just give that to you. Minus my required profit. So just think of NOPAT as my investment center income. The way I get to my required profit is I take my cost of capital times my invested assets. Okay? This right over here, the way we calculate the investment is we take our total assets minus our non-interest-bearing current liabilities. Examples of non-interest-bearing current liabilities would be accounts payable, for example. And the reason that we could subtract those out is because they don't carry interest and they would be considered a free source of funds. Okay? So if we look at this example problem, we have the same information as the other problem on the other page, right? And we're just going to calculate residual income, assuming the cost of capital is 10%. So we take our $16 million minus our $195 million, which was our invested assets. We weren't given any non-interest-bearing current liabilities, times 0.1. And when we do the math, we get a loss, a negative number, $3,500,000. So what this is telling you is that you made $16 million. Davenport Mills made $16 million, but they should have made $19,500,000, which is our 195 times 0.1, 10%. They should have made that number, but they only made $16 million. They underperformed, therefore. And so our residual income is negative, which would be a bad thing. If this were positive, then it means that our profit that we had is in excess of our required profit. Okay, thank you so much. Goodbye.